Welcome again. So let's see the transactions that is supposed to be recorded in the books of Leases. So as we mentioned before, um, the leasee is supposed to recognize the amount as liability. That is the lease. So the first transaction is about uh, the payment for that liability. So when the leasee recognizes the amount payable as liability, and a part of the liability is now being paid. So the first installment, when he paid, then the lease liability debit and bank account credit. So first he is recognizing the amount as liability, right? So the asset account debit and say liability account credit, and then so when the liability paid, the liability decrease, right? And bank account credit, and the leasee is becoming the owner. And according to accounting standard, as we mentioned before, supposed to recognize the amount as asset in his books of accounts. So the lease asset account debit and bank account credit. If he pays anything because of ownership, right? The payment made in relation to the lease asset before commencement of the lease. For example, say something in advance. Lease or accounting. So under the finance lease, effectively the rights and benefits associated with the lease has been transferred to the leasee, as we mentioned before in the definition. So the risk and liabilities and the benefits, everything goes to the leasee. So leaser doesn't require to show the property in his books of accounts when it is leased, but the leaser is expecting money from the leasee. So the money what is supposed to receive in 10 years, the whole amount is supposed to recognize as lease receivable. All right. And the leaser also will receive, because he is receiving the money in installment, he will receive the interest on the money as well. All right. So the interest is supposed to be recorded in the books of account as income. But in case of operating lease, because the leasee is not getting the ownership of the asset, the ownership still will remain with the leaser. So in this case, the leaser will recognize the asset in the books of accounts, in the balance sheet. As usual, normal asset, the leaser will record the asset in his books of account and also recognize depreciation in his books of accounts. So everything as a normal asset. The leaser will recognize that. And the money uh, received from the leasee would be recognized as only revenue, as rent, normal income. There are some sorts of instances like you can sell the asset, but you want to use that asset after selling it. So you can sell, but you will continue to use the asset as a leasee. This is what we call sale and lease back. It's not a common scenario, but this is what we can see, we can find. So if you have money, you purchased an asset, but if you don't, then what you can do, you have to use the asset as a you should get the asset as a lease. But for example, you purchased an asset, but you can't continue. What do you have to do? You are facing financial difficulty. So what you can do, you can sell the asset to a finance company, right? And then the finance company um, will get the benefit from you because you are using the asset. So you were the owner, but now you sold the asset to the finance company. Currently, you are not the owner, but you are still using the asset as a kind of mortgage, as a and you are paying installments to the finance company because of using, and maybe if it is a finance lease, getting the ownership gradually in 10 years. So um, as a lease, in this case, you are not actually losing the control of the asset. You were the owner, and you were controlling the asset. Now you are leasing, you are controlling the asset, the finance lease, and you are using the asset at the same time. This is what we call sale and lease back. And and it is also almost the same thing, but only there are some kind of additional transaction you are supposed to make. So it is very simple. It's only because of as you were selling, you were the owner and you sold it. The change of ownership happened, and there are some additional transactions that you are supposed to make. Nothing else. Yeah. So let's see an example of a finance lease, and we will see the records in the books of accounts. Finance corporation purchased an asset for 27,966 for a lease to manufacture on 1st of January with the terms that 10,000 is payable at the end of each of the 3 years. So that is every year you'll make 10,000 payments, and the lease is for 3 years. So 10,000 and 10,000 and 10,000 every year you are making 10,000 payments. This is what the fixed payment. And in addition, a variable payment is based on uses. And manufacturing estimates, these will be 100, 150, and 200. The first year 100, second year 150, and third year 200. Finally, there is a payment of 1,000 to finance at the end of the contract. That is, as we say, is the guaranteed residual value. So at the end of the 3 years, you'll pay 1,000. So what would be the amount in total? So in the 0 year, you are not paying anything. At the end of year 1, you are making 10,000 payment, fixed payment, and then second year 10,000, third year 10,000. And based on the use, 100 at the end of first year, 150 at the end of second year, 200 at the end of third year. And finally, the guaranteed lease payment is 1,000 at the end of third year. So what's the total? The total payment at the end of first year is 10,100. Total at the end of second year is 10,150, and total of third year is 11,200. So if the interest rate is considered as 6%, right, then what would be the present value of these payments? See, if you discount these figures, so this is the value, you have to discount it for 1 year at 6%. This is the amount that you have to discount for 2 years at 6%, and this is the amount you have to discount it for 3 years at 6%, and then you'll get the present value of this figure, and this figure, and then if you add all these three, and then you will get this figure, 27,966. If you didn't understand that, this, see, you can see the present value table. Okay, present value table, where you will see years one side, on the vertical side, on the left hand side, and then on the top horizontal part you will see the interest rate. So if you go for year one 6%, you will find a present value factor. Okay, and for second year at 6% you will get another present value, and third year 6% you will find a present value factor. And then if you multiply those factor respectively with these figures, you'll get the present values of these installments. And if you add those present values, you'll get these amounts. All right. So the records, the journal entries in the books of accounts of the leasee, how you will record it? As we mentioned before, firstly, the whole amount you should recognize as your liability, and the lease asset should be recognized in the books of account as your asset. So it is recognized as a lease asset, debit, asset, debit when it increases. So you are getting an asset as lease, so you have to recognize the asset in your books of account, asset, debit, and lease liability. Liability always credit. So if liability increase, it will credit. So lease liability, the whole amount is the liability that you are supposed to pay in 3 years. So this is the asset and liability on the first day of January. And that's why these are supposed to be present value. And this is the present value that we have calculated in the previous slide, 27,966. And end of the useful life, end of the first call, every year of the 3 years life, as usual, we have to show or recognize depreciation of the asset, what we can call as amortization or depreciation expense. So if you think there are different depreciation methods. So if you use a straight line method, so every year it would be same amount of depreciation, equal amount. So 27,966 divided by 3, then you'll get 9,322 as the depreciation, equal amount, the same amount of depreciation for first year. So 31st of December, first year. So this is the amortization expense, depreciation expense, and provision for amortization, or traditionally you can recognize as lease asset credit, amortization debit, or depreciation expense debit, lease asset credit or asset account credit, this amount. And as we mentioned before, at the end of the first year, you will pay actually 10,100, right? But the money, the liability that we recognized here as the present value, first day. So on this amount for the whole year, you are supposed to pay interest, right? Because you are paying at the end, but recognizing the liability at the beginning. So for example, you are getting this amount as loan, but at the end of the year, how much you are supposed to pay? You are supposed to pay the principal, the loan amount, and also the interest. So this is how you have to pay the interest on this figure for the whole year. So the amount of interest that we need to calculate as recognized in the as the interest rate is 6%, so 6% of 27,966 for the first year. So the interest amount comes 1,678. So interest expense for the leasee. So interest expense debit and lease liability credit. This is the liability that you are supposed to pay to the leaser. So interest is being paid by leasee to the leaser, and that's why this is the expense of the leasee. So how much the leasee is paying to the leaser at the end of the year is, as we calculated before, first year 10,100. So the 10,100 is paid. So liability debit, liability decrease. You are paying the amount. You are making payments from your obligation. So your obligation, your liability is decreasing. As we mentioned before, liability increase, liability is credit, but when you pay it, liability is reduced. So when liability decrease, then you are canceling some liability. So it is coming down. So liability decrease, debit, and bank account. You are paying. Bank balance is usually debit because it is asset, but when you pay, your bank balance decrease. Asset decrease, credit. Liability decrease, debit. Opposite. In the books of leisure, so as a leisure, what he will record? As we mentioned before, the leisure will recognize the purchase of the asset, that is bank account credit, because of purchase. The leaser purchased the asset for leasing, and the leaser will receive this money 27,966 from leasee. In 3 years, leaser will receive this amount from leaser. The money is receivable, so this is recognized as asset. So lease receivable debit, asset increase, and bank account credit. So bank account another asset decrease, because the leaser paid this money to purchase the asset for finance lease. So if I want to give my property to a leasee for use, I have to purchase an asset. So if I purchase it now, then I have to recognize that I purchased it. Okay. And the interest at the end of the year, the leaser will recognize the interest. The leasee recognize the interest as expense, but the leaser will recognize the same interest as revenue, because the leasee is paying and leaser is receiving. So when leaser is receiving or expecting to receive, that is receivable. So lease receivable, interest receivable, right, is debit. The leaser will receive the money, and interest revenue, the amount will come as an income from the leasee. That's why he's recognized this amount as income, as revenue. All right. So firstly, is recognizing, recording in the books that I will receive this money. Leaser is recognizing this, that I will receive this money. And then when he receives, he records the money like this. So leaser receiving the money now from the leasee. So when receive, bank debit, because bank balance increase, asset increase. So leasee received the money from, leaser received the money from leasee. So bank balance increase, asset increase, debit, and lease receivable decrease. Remember, in the first entry, he said 27,966 I will receive during 3 years. Okay, so at the end of first year, when he receives some money from here, so this receivable amount will decrease, asset decrease. When I'm saying I will receive, then I'm writing it as an asset. But when I received it, then my receivable will decrease, receivable decrease, asset decrease. So this is being recognized as credit. In case of operating lease, previous example was finance lease when the lessee becomes the owner. But in case of operating lease, the ownership will remain with the lessor. So in this case, the transaction will differ. Reports will be different. So in case of operating lease, the lessor purchased the asset. When he purchased, he will record as normal purchase transaction, asset debit bank credit. If it purchased in cash or by bank account. But if purchased on account credit, then it would be creditor, should be recognized as liability. So if he purchased a furniture, a machinery, or whatever, he will record a machinery account debit or furniture account debit, bank account credit, or creditor account credit. All right. And depreciation, as we mentioned before, the ownership will remain with the lessor. So as normal property, as normal asset, the lessor should recognize the depreciation. So depreciation expense debit and provision for depreciation or asset account credit. Depreciation debit, asset account credit. This is your asset, you have to recognize. As we know, normally, if you don't know what is depreciation, so for fixed asset, we expect that the fixed asset will benefit me for certain period of time. And then during that period, I should depreciate or amortize that money by which I purchase the asset. I purchase the asset. So if I purchase an asset for 10,000, for example, and I am expecting that I would be able to use that property for 5 years. So every year my expenditure is 2,000. 10,000 divided by 5 years. So every year I will show in my books of accounts that my expense for this property is 2,000. And this 2,000 is what we call in accounting term as depreciation expense. And yeah, when he received the money from the lessor, received the money for using up of the asset from the lessee, then he recognized as this bank account debit, and the revenue receivable debit and revenue account credit, right? So recognize revenue evenly throughout the contract during the year. Yeah, so this is what the basics of lease, accounting for lease, accounting standards for lease, and some idea about how the lease become popular, why lease is popular, advantages of leasing to the lessor and to the lessee. And yeah, I think the basics are to some extent is clear to you. And if not, obviously we will discuss further in our seminar. And thank you very much for watching this part as well, and see you in the seminar. Thank you very much.